banks can take a lot of loan losses, but they can't take something that wipes out their capital and expect the world to ignore that fact. If those rates change, let the person who bet that they wouldn't change lose money. I mean, that's if you make mistakes in business, there's plenty of people make mistakes.
Legendary investor Warren Buffett is warning about a $2.2 trillion storm that's about to strike the banking industry, and the consequences could be felt for years to come. A problem of this magnitude didn't form overnight. Its roots go back more than 40 years, and now it's finally too big to ignore. With each passing day, we're getting closer to impact. Listen to Buffett explain.
Had lots of investors in commercial real estate who have come in and said that this is going to be a crisis point, that the government is going to have to step in, that something should be done because there are so many commercial real estate loans that are coming due between now and 2025, and that they won't be able to get credit from the banks in the same way to renew or to, once those maturities come due, to refinance.
Well, let's say they lose $100 billion in the banking system. Most of the banks can take that loss, their share of that loss, and a few of them, because they did other things, their shareholders will end up losing the money, but the depositors won't lose money. But if you lend money to somebody and it comes due and they can't pay, the old story about the banker, I never made a bad loan. Of course, some of them turned bad after I made them. I mean, and that's exactly what happens in, whether it's in commercial real estate. And if money rates are 2%, or we were lending money out at 4 basis points at Berkshire to the federal government, not much more than a year and a half ago, or something like that. And if those rates change, let the person who bet that they wouldn't change lose money. I mean, that's if you make mistakes in business, there's plenty of people make mistakes. You pay for them. If you've got a big profitable business on top of it, which a good many banks do, you take your losses and you keep going on. I mean, banks can take a lot of loan losses, but they can't take something that wipes out their capital and expect the world to ignore that fact.
Meaning that you don't think anything needs to be done on the commercial real estate front?
Well, I think that the people who lend too much money should take losses, and they're getting properties handed back to them now. I mean, within the last month or 6 weeks.
Banks are.
Yeah, I mean, they got some office buildings in Los Angeles, and Blackstone walked away from something. I mean, and if you get a non-recourse, everybody goes in the real estate business is told the first rule, the second rule, the third rule is never sign your name to anything. And so you have non-recourse mortgages, and they're going to walk away, and the bank's going to get stuck with losses, and maybe they'll hold the property a long time, and it'll come back. And there's all kinds of ways that if you got capital strength, you may decide, well, I'll just hold it, but that money is sterile for quite a while, and that's part of banking. I mean, you expect to lose some money in banking. It's not a sure thing on every loan, and you build that into your calculations, and then you have capital that protects your depositors from it eating into their money. And if it does eat into their money, then the FDIC, which is in effect really a mutual insurance company of a very peculiar sort, essentially spreads the losses among the continuing banks by higher FDIC assessments in the future.
To truly understand Warren Buffett's warning, you first need to understand how banks actually operate. At their core, banks are in the business of lending money, which sounds simple enough. They lend money to people and businesses that need it, and those borrowers pay it back with interest over time. The borrower gets to buy something they otherwise couldn't afford, and the bank makes a profit from the interest. Most people understand this part of the process, but what many don't realize is that banks aren't usually lending their own money. And this is where things get risky. To explain this, imagine a simple story between 3 friends, John, Michael, and Tim. Michael wants to take his dream girl out on a date, but he's short on cash. He asks John to lend him $100, promising to pay back $120 on Monday after he gets his paycheck. John likes the idea, but he only has $20, so he borrows $80 from their friend Tim, offering $10 in interest. John gives Michael the $100, and everything goes smoothly. On Monday, Michael pays John $120, and John pays Tim $90. John ends up making a $10 profit using mostly borrowed money. As strange as this sounds, this is basically how banks work. Banks take deposits from customers like Tim's savings, then lend that money to borrowers like Michael. The The bank earns profit from the difference between what it pays depositors in interest and what it charges borrowers. This difference is called the spread. When everything goes according to plan, this model works beautifully. But when borrowers can't repay their loans, the entire system can crumble, and that's exactly what Buffett is warning about. Let's replay the story. But this time things go wrong. Michael's date goes horribly, and he doesn't show up to work Monday, meaning he can't pay John back. Now John can't pay Tim back either. What was supposed to be a smart deal suddenly becomes a chain reaction of losses. This, on a massive scale, is what's happening in today's banking system, except instead of $100, we're talking about an estimated $2.2 trillion in potentially troubled loans. And most of the problem comes down to 3 words: asterisk asterisk commercial real estate loans. To see how we got here, we need to look back at interest rates. In the early 1980s, U.S. interest rates peaked near 20%. From there, rates fell for nearly 4 decades, hitting near zero after the 2008 financial crisis and staying there for more than a decade. This long decline in interest rates made borrowing incredibly cheap and fueled massive growth in real estate values. People and companies could easily borrow more, and that easy money drove property prices to record highs. For 40 years, this was seen as a golden age of growth. But now, everything has changed. When the Federal Reserve started aggressively raising interest rates in 2022 to fight inflation, it triggered one of the fastest rate increases in history. Today, rates are at their highest level in 20 years. The problem is that many of the $2.20 trillion in commercial real estate loans banks hold were made back when rates were much lower. As those loans reset to higher rates, many borrowers can no longer afford their payments. For example, imagine a property owner whose building earns $100,000 a year after expenses. He has a $2 million loan that's interest-only, meaning he just pays interest, not the principal. When rates were 3%, his yearly payment was $60,000, easily covered by his income. But if rates reset to 6%, his payment jumps to $120,000 more than the property even earns. He's underwater. Unless he can pay the difference, the bank will likely seize the property and take a big loss. Now, a few bad loans like this might not seem like a huge deal, but for banks, it adds up fast. Let's say a bank has $100 million in outstanding loans and $10 million set aside as a safety buffer, known as capital reserves. If just 20% of those loans go bad, that's $20 million, and the bank only recovers 70% of it by selling properties. It loses $6 million. That loss eats into the reserve, leaving just $4 million. When news of that loss spreads, customers panic and rush to withdraw their money. Here's the issue. Banks don't actually hold most deposits in cash. They've already lent that money out. So when too many people withdraw funds at once, the bank runs out of cash and collapses. It's the same story we've seen throughout history, from the Great Depression to the 2008 crisis. A bank run fueled by fear and bad loans. While big Wall Street banks might survive such hits, smaller community and regional banks are much more vulnerable. In fact, nearly 2/3 of all real estate loans in the U.S. are held by small and mid-sized banks, not the large national ones. These local banks are the lifeblood of small businesses and local economies. They're the ones lending to restaurant owners, local developers, and small-town entrepreneurs. When these banks take big loan losses, they tighten their lending standards or stop lending altogether. That means a local restaurant that's thriving and wants to expand may suddenly find its loan denied. Without funding, the new location doesn't open. Contractors, electricians, plumbers, and real estate agents who would have benefited from the expansion lose business. This is how trouble in the banking sector ripples across the economy. Quietly but powerfully. Warren Buffett believes that some banks simply won't survive this storm. Rising interest rates, falling property values, and trillions in debt have created a perfect storm. The big question now isn't whether banks will fail, it's how many and how far the damage will spread. History shows that once one domino falls, it rarely stops there. And Buffett's message couldn't be clearer. This $2.2 trillion storm isn't coming, it's already forming. Banks and property owners aren't the only ones at risk. The entire economy could feel the impact. Imagine a small apartment building owner who earns $100,000. A year after expenses, he has a $2 million interest-only loan on the property, meaning he only pays interest each year. When interest rates were 3%, his annual payment was $60,000, easily covered by his $100,000 income. But as rates rose, things began to tighten. At 4%, his interest payment increased to $80,000, leaving little room for profit. And when rates hit 6%, the payment soared to $120,000, more than the property even earns in a year. Suddenly, he's underwater. Unless he can make up the difference, the bank will likely seize the property and take a loss when selling it. This is where banks start to feel real pain. It doesn't take much to push a bank to the edge. Suppose a bank has $100 million in outstanding loans. funded mostly by customer deposits rather than its own money. By regulation, the bank must keep a portion of its own funds as a capital reserve, a safety cushion for bad loans or withdrawal requests. Let's say this reserve is $10 million. Under normal conditions, that's enough. But if 20% of loans or $20 million go bad, and the bank only recovers 70% through selling properties, it loses $6 million. That loss comes straight out of the $10 million reserve, leaving just $4 million. When news of the losses spreads, panic sets in. Customers rush to withdraw their money. But banks don't actually keep most deposits in cash. They've already loaned that money out. This creates a dangerous mismatch known as lending long and borrowing short. Banks issue long-term loans that take years to repay, but their depositors can withdraw funds instantly. As withdrawals pile up, the reserves shrink rapidly. Once the reserves run out, the bank fails. While deposit insurance in the U.S. protects customers up to $250,000 per account, it doesn't stop the wider economic ripple effects. The real danger is that most real estate loans, nearly two-thirds, are held by small and mid-sized banks, not the massive Wall Street giants. These local banks are vital to their communities. They fund small businesses, developers, and local entrepreneurs. When they suffer losses, they pull back on lending or shut down entirely, choking off the flow of money to the real economy. To understand how that plays out, imagine a successful restaurant in your town. It's always packed, and the owner wants to open a second location. Normally, the owner would get a loan from a local bank. If the loan is approved, everyone benefits: contractors, electricians, plumbers, painters, real estate agents, and accountants all get work. Money circulates through the community. But if the bank is struggling with bad loans, it may have to deny the restaurant's request. The new location never opens, and that entire chain of opportunity disappears. This scenario isn't just theory. It's already happening across the U.S. Thousands of businesses are finding it harder to get loans as banks tighten credit. It's a slow-moving crisis, but one that touches every part of the economy, from small towns to major cities. Warren Buffett warns that some banks won't survive this storm. The combination of rising rates, falling property values, and trillions in debt has created a fragile financial system. The question isn't if banks will fail, it's how many, and how far the damage will spread. So, there we have it. Make sure to subscribe to the channel, because my goal is to help you become a smarter investor by learning from the world's greatest minds, like Warren Buffett. Talk to you again soon.